Hi, I'm Nicholas and welcome to Kathmere Capital's first quarter update for 2019. Just want to give you a couple updates on both the markets, the economy, give you a couple things that we're thinking about here, and then a little pop quiz at the end here. So we're going to keep this to about 10 minutes, maybe even shorter. So give you an update, as I'm sure that you guys are aware, fourth quarter of last year was pretty tough, but first quarter of this year was great. We had U.S. markets up 14, international markets up about 11. U.S. bonds and international bonds also did positive, about 3%. So these green bars that you see here are going to be year to date, and the gray bars are 1 year. We also had real estate do incredibly well over the last 12 months and also year to date. And the last one here, cash, is starting to finally pay off a little bit. So as everyone's seen, the money market accounts and CD rates have gone up quite a bit. One thing that we want to touch on is, I'm sure you guys are aware, 2017, you probably saw this chart if you reviewed with us recently. 2017 was a great year. 2018 was pretty tough. We talked about this at the fourth quarter update last year. And then so far 2019 has been great. We're within a spitting distance from all-time highs, about 2%, 3% off of all-time highs. Done incredibly well. Big comeback from where we were end of December last year. Something you probably heard in the news a lot recently is the yield curve. We've had that flatten almost to the point of inversion, depending on the index that you want to follow or the metric that you want to look at. And so what we charted here was, we see the 10-year Treasury notes have been pretty consistent over the last handful of years here. What you see here in purple is the Fed funds rate, and that's really what has dictated the short-term bonds and their notes, their yields that we've seen. That came to a head about 3 weeks ago or so when we saw the two invert, where the long-term went under the short-term. That is typically a sign, and we're going to talk about in a second, when people are getting a little more nervous about the markets. So one thing that a lot of people want to talk about with the inverted yield curve is that all of a sudden you see this big inverted yield curve means a recession is definitely coming. And we wanted to put some numbers behind that, let you guys know that yes, statistically, every time that has happened before, or historically, I guess I should say, every time that's happened before, it has happened. But it's a very hard tool to use to time when you should then go to cash or when you should reduce your risk in the markets. And so what we did here was just put how many times did that happen recently, going all the way back to the 60s. How long did that take from the time the yield curve inverted to then all of a sudden when it flipped and actually became a recession or a concern? And then one thing we put on here as an interesting data point is what happened as far as returns go from the time that we hit the negative yield or the inverted yield curve, and then what was the return until the recession came. So going back over time, you go back to the 60s, you had from 60 to 65, it was about 5 years that we saw the first sign of an inverted yield curve to when the recession actually came, and the market was positive, just a hair. And then we chart a bunch of different ones here. And what I want you to understand in looking at this is that what we see is, 5 years down to less than a year was the timing. So it's very hard to tell. It's one of those that we really don't put a lot of fact behind that we're going to see a recession immediately because the inverted yield curve. It is one of those that does follow, but what's the timing of it? Is it a year or is it 5 years? And then the one thing to also keep in mind is what's the return from when that happens to then when the recession comes on. And that's about 10% on average, but we get anywhere from a negative 15 back in the 70, 73 time frame all the way up to a plus 34%, 89 into 90. So you can get a huge return out of the markets even with this inverted yield curve. So it is one that we look at, we do monitor. It has since, after that did invert, it has then come back. It was a very quick inverted yield curve. It is now back to normal, but still very flat. But it's just one of those things we want to touch on. We saw it in the news a lot and we thought it'd be interesting to touch on. So portfolios specifically, what we want to do is look at a couple different things. Two areas of the market that we've seen underperform the U.S. stock market here. And as U.S. investors, we are very biased to the U.S., so we follow the indexes here, S&P 500 and the Dow very closely. Two things that we thought we'd just pull out, and we've talked about this in the past, so if you've read our articles or you've watched some of these videos in the past, you've noticed this. We want to touch on international and really what has it done compared to the U.S., and then value stocks, value investing, and the Warren Buffett type of investing, buy something inexpensive or cheap compared to its peers, hold it for a long period of time. What has happened? And what we've noticed is that on the international side and the value side, we've seen a great underperformance for 5 years or so. And so we put in here was U.S. stocks in green, international stocks, large cap international in blue, and then the light blue is emerging markets. And as you can see, every metric that we look at, both year to date all the way out to 5 years, you're going to see the U.S. drastically outperform on the international. We'll touch on what that means, what we think that then presents actually an opportunity for us here. But it's just been interesting to see such a strong outperformance on the U.S. side coming out of the Great Recession about 10 years ago. On the value side of things, we've seen also a similar underperformance, not as drastic, but you've seen anywhere from over the last 3 years, U.S. stocks do 13% and value do anywhere from 10.5%. And then on the 5 years, it's been down about 3% comparatively. So still done incredibly well, up 7% over the last 5 years, but that's one of those things that we do monitor, we do watch about the internals of the market, and we think value investing is proven its strength, and we'll talk on that in a second. But one thing that we've just noticed over the last handful of years we wanted to share with you. So international stocks, how has it underperformed and how long has this been going on? Well, it's really only been happening since the Great Recession, or Great Financial Crisis, I guess is what it's called. If you go back to the 70s, we actually had a strong outperformance. So what we're looking at here to give you this chart is over top here, anything above this, when the blue line is above here, is when the international stocks have been beating the U.S. stocks on a 3-year rolling basis. 5-year rolling basis. And anything under here is when the U.S. stocks have been outperforming international on a 5-year rolling basis. So we've had some pretty strong, you go back to the 70s, you had really strong international, about 5% annualized. And then you had a big increase in the 80s where it went all the way up to almost 20% annualized beat of the S&P 500 of the U.S. stocks. Go even back to the 2000s. A lot of us didn't recall this, but you go from about 99 into early 2000, right before the Great Financial Crisis, you had international stocks beating U.S. stocks anywhere from 5 to 10% on a 5-year rolling basis. Since then, though, we've seen U.S. stocks, and again, this is when U.S. stocks are outperforming international on 5-year. And we've seen that since 2009 all the way forward. We've seen a 5 to 10% outperformance on an annualized basis. So a pretty good clip on an annualized basis. But really, a lot of that has actually come from earnings ratios. And so what we wanted to show was really price to earnings, PE ratios, how much are you paying for every dollar of earnings. U.S. stocks are in blue here. International stocks are in red. This is the CAPE ratio, which is a way of looking at cyclically adjusted PE ratios. And you can see, pull out, back in the 80s, this is when Japan was incredibly highly valued, 100 plus PE ratios. But what we've seen is these do kind of go hand in hand and flip-flop back and forth, who's higher, who's lower, a little bit on the US side, a little higher through periods, and then international higher as well. But since we both bottomed out in 2008, 2009, US stocks have been getting an increasingly higher PE ratio, price to earnings ratio, and international has stayed very flat. And so we actually have the widest margin that we've had where US has outperformed international since this data has been put in back in the 70s when they first started putting all this data together. And right now, when you look at our PE ratios as of the end of February, we have about a 30 PE here in the US, and you look at international stocks, even large cap international, anywhere from 22 down to 17, and emerging markets are even cheaper on a PE ratio. So that just sees where we think that there does appear to be very attractive compared to the US markets, where we do think there could be some outperformance there, or at least we're paying a heck of a lot less for every dollar of earnings there. It seems very attractive compared to the US stocks. We also want to touch on value. We've talked about that a lot in the past. We've written a lot about it. Why do we continue to believe in it? Well, if you go back to the 20s, about 80-year, 90-year history here, we see strong outperformance in US stocks, international stocks, and emerging markets where value has beat the just core index. But what has happened and how often has that happened has been kind of all over the place. So it's been 60% of the time on a 1-year basis. If you go out to a 5-year basis, it's about 75% of the time. And if you come out to a 10-year basis, it's about 83% of the time. We just happen to be in one of those periods where we have seen the pretty good underperformance there. But again, just wanted to give you some numbers behind that. And what does that correlate close to is how many times does stocks beat cash? It's interesting, about 69% on a 1-year basis, 79% on a 5-year basis, on a 10-year basis, 85. So very close numbers between the two. Just wanted to, one of those things we talk about a lot when we look at this is would you rather own cash or stocks for the long haul? Most people would probably say stocks. And our percentages are roughly the same on value versus growth and the markets there. So we like to just bring a little bit of humor into this one. And one thing when you look at it, even the best guys go through tough times. Warren Buffett, look at his track record going back to the 90s. He's, for every dollar of earnings that went in, or every dollar that went in invested, he's now worth $45 compared to the S&P 500, which is worth about 13.5. So a huge outperformance there. But during that period of time, we had huge underperformances, 20+% underperformance on a 3-year rolling basis. An interesting headline in December of 99, what's wrong with Warren? Barron's came out with a report saying that what's wrong? Why is he doing so poorly? What is he, has he lost his luster? Should he get out of it? Interesting to say that, he's continued to do incredibly well since then. So just one of those things interesting that we like to bring in there. And then lastly, when we look at it, just a little pop quiz for you. I told you we'd suck. What percentage of time do you think the S&P 500 has returned an average return? So any from average return has been 10%. So we'll give you plus or minus 2, 8 to 12%. And we're going to go back far. So take a percentage time. Do you think it's 50, 30, 20, 80? What do you think percentage of time that it's been? Put this together. Thought it was really interesting. If you plot this out over the entire period of time, going back to 1926, when we actually add in all the numbers here, it's only been 1, 2, 3, 4, 5, 6 times that we've actually seen it within that all the way back to 1926. So just thought we'd leave you with that interesting little bit of tidbit of knowledge there for you. Only 6 times in 93 years has it been the average. So let's all take the average with a huge grain of salt. Thanks. We hope you enjoyed this. Have a great day.